Taimur Baig actually is in our studios now. Taimur, hi, good morning.
Good morning.
Good to have you in India and in our studios. So what did you make of the Fed statement and the fact that we had so much volatility in asset markets, but the dollar has been strengthening?
Right. So even if you put the whole Trump narrative aside, I think November, December was a time when we would have seen some strengthening of markets in any case. The OPEC-related developments have nothing to do with Trump. The fact that inventories are drawing down in industrial economies around the world is not a Trump-related development. So with or without that complicating factor, we've had a bit of a secular upswing in global activities, led by commodities, but also supported by industrials. So in this context, the Trump narrative adds some fuel to the fire, and the Fed cannot help but react. So the 3 rate hike narrative that we now are beginning to absorb, and mind you, now the dots by the Fed governors and the market expectations are more or less aligned. This is a rare phenomenon, right? In the last few years, the markets have been far more dovish than the Fed and have pulled the Fed down to their levels. So we are seeing a bit of a truce between the markets and the Fed. Trump may have done that.
Okay, but that's interesting that you say that industrial economies are now, almost at a point where the excess capacity is gone. But what does this mean actually for, asset allocation? Are you going to see emerging markets suffer as much because of the dollar strength? Or will it not be so much? So,
as somebody who lives and dies with the EM, I'd like to think that there is some silver lining for the EM in this strong dollar, strong rates narrative. But it's a stretch. Typically, if you look at the last 30 years, every time we have seen a secular rise in U.S. interest rates or a strong dollar cycle, it's been very, very difficult for emerging market equities and debt. We have an EM that is heavily indebted. We have an EM that is still hugely reliant on DM demand. Now, hopefully, the demand pull would outweigh the rest of the negative dynamic. But therein lies the Trump complication. Is it going to be a zero-sum recovery in the West, where the U.S. grows at the expense of us? Then we don't benefit from this.
Okay. Taimur, morning. I'm more interested in your thoughts on demonetization because, we've seen now the situation exacerbating a bit. I mean, lesser amount of ATMs are recalibrated. We are seeing a lot of corruption with the bank officials. Do you get a sense that the impact on GDP and consumption trends could be far worse than what was earlier anticipated?
We still have too little data to make a very strong bottom on this. Because, all the November data point that we're going to get will be tainted by the fact that there was an early Diwali this year. So we need to basically look at data October plus November on a year-on-year basis. For example, auto, right? The November poor auto sales data, when you look at it in combination with the October numbers, don't look that bad. So I think we need to say December data, but then we have to basically be in January or February to come back and look what happened to the disruptive economy. But I was with the consensus initially, which was that it'll be a short-term disruption followed by a bit of a V-shaped recovery in the, say, beginning of next year or toward the second quarter of calendar next year. I'm beginning to wonder whether I was too shallow in my analysis, if you will, that there are some deeper dynamic at play, that companies that have always operated on the margin, not part of the formal economy, not paying taxes, will they simply die as a result of demonetization, and would that create medium-term headwinds to the economy? We haven't really talked about that issue. Right now, we're only talking about the cash-related disruption, how to bring in more cash. But there is a more fundamental underlying theme here, which is what happens when the economy is forced to become more formal.
Not only those companies, but what about the rural pocket that has faced the bigger brunt, or rather, the largest brunt of the whole issue?
Right. So I'm particularly looking at agriculture processing. So I was looking at a company that supplies edible oil to rural sector in India, and they had to suspend their production for a while because of the confusion around demonetization. They're back online. So that's an interesting case study, that there was severe disruption in the second, third week of November, but by early December, they're back online, they're supplying. So maybe the rural demand, which is usually about necessities, agriculture cycle related, may be disrupted only temporarily. But we need to then start thinking about the medium-term implication, not just a short-term issue.
Okay. Taimur, well, last year, the Indian macros were looking quite benign. Now, with crude prices also showing signs of surge, does that change things for India for 2017 and 2018?
I wouldn't worry about it. In fact, the lower commodity price have hurt India in multiple dimensions, which will go away. India has a very large oil refining sector. It has a mining sector, and these have been under deep recession the last 3 years. So we will see some offset there as commodity prices recover. Nobody is really predicting a major bubble in the commodity markets, right? So if oil goes to 55, 60, it might be a bit of a Goldilocks. Some of the distressed part of the economy recovers, but inflationary implications are not that dire. So I wouldn't worry too much about 2017 with respect to commodities.
So how does the growth inflation dynamic play out? First of all, how much have you reduced your growth numbers for this year and the next, even if it is only directional? How much is it?
Right.
And how much elbow room does the Reserve Bank have in the light of what you're saying about commodity prices and the Fed's hiking?
No, it's a rather sort of foggy outlook right now.
For growth.
For growth and for inflation, because if you do believe that some of the pass-through from commodities will take place on the fuel and diesel part of the CPI index, maybe the disinflation is as good as we've seen so far, unless, of course, the demonetization disinflation starts showing up in rand and other areas. But again, too little data right now to make a strong call. So we've been lazy. We are with the consensus about 50 to 75 basis points downside to FY 16-17 growth, and then for 17-18, some sort of a recovery to the low sevens. I still am confused about what the GDP number means overall, but bottom line is that activity has suffered. It should pick up, but we need to start thinking about the medium-term implications, not just a short-term issue.
Okay, finally, the rupee. I mean, sorry, yesterday's trade deficit data, I'm really sorry. Yesterday's trade deficit data indicated that, the deficit has gone back to 13 billion per month. Would you worry now? I mean, crude prices have not yet risen.
Right.
They may rise next quarter.
Right.
Are we going to see the rupee beginning to register pressure?
Lata, even independent of the commodity issue, I'm a rupee bear. I look at 72.5 rupee by the end of next year, 75 by 2018, because I think that India has been a bit of a laggard in that whole EM capitulation to DM rally. There is no upside for India in remaining an outlier in this area. So the RBI should let the rupee go if that weakens. And so therefore, regardless of what happens to commodity prices, I think the rupee weakens steadily from here onward.
Okay, I just wanted one follow-up to the point you were making about rural India. What are your thoughts on urban and corporate India? Has the cash crunch issue been resolved a bit, or is there some more pain to go, maybe for a couple of quarters?
Right. So areas like real estate, I think, is at a standstill right now. We haven't really seen prices fall, but clearly, there are a lot of people who are sort of circling around the developers saying, can you give us a better deal, given that, demonetization means there should be disinflation. So we're seeing a bit of a standoff between developers versus potential buyers. There's only one possible outcome. There will be a downward revision to prices, but we haven't seen that yet. But that's more of a 2017 story in my view than right now what's going on. Beyond that, I think it might be more of a temporary disruption story. Like auto sales, I said, we really need to see December number before making a very big story out of that. But my other concern is the industries that are export-oriented. You were earlier referring before my segment about a pharma company having a lot of trouble in the U.S. because of legal issues. As the U.S. turns more protectionist and more inward, would Indian IT, pharma, and even manufacturing companies feel more headwind? That is the big challenge going forward.
Okay, final question. What about the money market, the bond market? We have seen a lot of volatility of late, especially in the US market. What are your thoughts on that?
Right. I thought we were going to talk about the Indian bond market.
But please extend it to India as well.
So the US story is interesting. We were not particularly bearish the fixed income even a few weeks ago. We thought that once the 10-year hits about 250, we're done. But the way inflation expectations have picked up in the US, even without any materialization of inflation shock, means that we can't really fight the trend right now. Fed is on a hiking mode. Everybody thinks fiscal expansion is coming. So we are very much on the pay rate story in the US. And also the whole repatriation of US dollar story could also add some complications to the bond story going forward. Although in the corporate debt market in the US, you could have a bifurcation where the treasuries sell off, but corporate debt remains attractive simply because of the bullish story in the commodity sector and tax cut expectations. Shall we
the
talk
Indian
about
10-year, yes?
Yeah, I mean, that's been quite the story in the last few months. So all my foreign clients who have been sort of leaving India have missed out on this amazing rally. And you do see one of those situations where domestics have been investing and the foreigners have been leaving. So global, local bifurcation, very, very stark in India. Look, the demonetization and the cash infusion must have some sort of a laudatory impact on bond market dynamic, and we're seeing that. But now with the MSS coming in, what it means for the fiscal. I mean, fiscal will have to now actually have 0.1, 0.2% of GDP worth of interest cost.
Payment.
If over the next, say, 12 months, let's say half of the cash that's come in stays in the banking system, and the banks, that liquidity has to be mopped up. So there's a fiscal cost to that. But at the same time, the next issuance of the government would be cheaper. So we have a countervailing dynamic here.
But does the 10-year go below 6, or has it seen its best already?
Yeah, I frankly can't see how it can go any better. Even if we believe that the RBI has some wiggle room left and will be cutting in the February and April meetings, the market has gone ahead of the RBI. Rather, we have seen this in many emerging market economies where the domestic liquidity situation makes the policy rate almost irrelevant. We're on the verge of seeing that in India right now.
Okay, it was super talking.